Yeah, good evening, everybody. So let's start a discussion. So this is a discussion regarding the content of your week 11 syllabus for this course on financial mathematics. So we discussed various things in this 11th week, and I think there was assignment also on this. Uh, Let me just check whether the deadline is passed or not. But anyway, I will not take the same questions. It doesn't really matter. But just for the sake of information, yeah, the deadline is still tomorrow, so we'll not take the exact questions, but more or less there will be similar questions only. So the broader topics that are involved, that were involved in this week 11 syllabus was where basically about risk management or risk measurement first of all, and typically conventionally we use standard deviation of historical data as the tool to measure the risk associated, because we don't know future. So usually uh, you know based on the historical returns, we assign certain expected returns, and that expected returns is nothing but combination of historical return or an average of certain period, and then you multiply with some probability numbers. Okay, so that is where you like that is where it is different. Okay, because the probability values that you assume, basically you are predicting the future, and you are assuming that let's say 30% chance is there that the the return that you got historically will be you'll receive that in your future also. Okay, so this probability values that you assign, that's a big thing. Okay, it's not that easy to do that. Nonetheless, people take some hints from the historical data, like based on the historical probability predictions. What can we do so that our future probability predictions would be more or less within certain bounds, something like that. Because everybody knows that you can't predict the future, but still, this is an educated attempt to do that. Okay, and there is always a risk that follows with it, because anything can go wrong, right? I mean, it's a prediction, right? So anything can go wrong, and many times it goes wrong. Very recent example, you might have heard about this US tariffs on various countries, right? So that's why like yesterday only on Monday, our equity market fell quite significantly, around 4-5%. The index fell 4-5%. Individual stocks were many of them were higher than that also. Okay, so such kind of events are called as unexpected events, and they will happen. So after COVID, this was one of those events where market was not ready to handle such a big news, and that's why there was a loss. But those things happen, and that's why these probabilities are there. Okay, so anyway, that's a different thing, but I just wanted to tell you what is the risk or what is the uncertainty that you carry. Okay, so risk means basically you can assign certain probability to that event. For example, uh, you know, uh, let's say in future some event is going to happen, and you know that it will happen on a certain day. For example, elections, the results of national elections, etc. The dates are very well fixed before the uh, before the event. So in such cases, you can study some historical results of the previous elections, etc., and then try to assign certain probabilities, so that you'll be making certain probabilistic guesses that what will happen on the election day. Okay, so that if you can assign certain risk to the event, that is usually under the category of risk. Okay, but there are certain events where you can't assign any probabilities because the information is not there. For example, COVID, that's a very good example, because uh, such event had happened like 100 years back, and at that time there were no stock markets or no equity markets, etc. So nobody knew when COVID like situation happened what was supposed to be the correct probability for that event. Okay, so all those things come under the category of uncertainties. Okay, And depending on what kind of event that you are handling, there are certain criteria based on which you take the decisions. Because at the end of the day, when you are investing, you have to decide whether to invest or not. If you decide to invest, how much should be the allocation to various types of assets, and then how much should be the sub allocation within the categories of those assets. Okay, so all those decisions need to be taken, and it's not good idea to keep that the decision making process without any rules or logic, because if you leave it up to a certain person, uh, there is a chance that he or she may go wrong, or because of some personal emotional biases, etc., the decisions can go wrong. So therefore there are certain criteria that are used. Okay, so in case of risks where you have certain ideas of probabilities, you use different criteria, like this dominance criteria, and there were 4 or 5 more: aspiration, most probable, expected value, expected variance, etc., etc. Whereas when it comes to the uncertainty, uh, you can't assign the probabilities, right? So then you have different criteria there. For example, Laplace criteria, maximin, maximax. Then you have Hurwitz criteria, and then you have minimax regret criteria. Okay, so there are many more, but these are what we are discussing in the class, and that's why we assume that they will be in your syllabus. Okay, so in those cases, we'll see based on certain examples. We'll see, and then towards the end of the syllabus for this week, there was discussion on risk premium, portfolio return, and risk. Okay, so basically, the main idea that uh, you consider when you have a diverse portfolio. See, there is a meaning of diverse portfolio is different than having multiple assets in your portfolio. Okay, many people mistakenly think that if I buy, let's say, 50 stocks in my equity portfolio, I am well diversified. But that's not the case, right? Because, for example, if the whole stock market is, in downturn, then there is a great chance that out of those 50 stocks, most of them will be also in red, or they will also be down. So in that case, even though you have increased number of assets in your equity portfolio or portfolio in general, the risk is not diversified basically, because all of them are performing similar under market downturn cycle. Okay, so that is not diversification. Diversification means you should have certain assets in your portfolio which are negatively correlated. What does that mean? That means if one asset goes down, another will go up, and vice versa. Okay, so there could be n number of assets. So some of them should go down, like when some of them go down, others should go up, and vice versa. That way, the overall risk or overall loss that you see in your portfolio on a daily basis will be not that much, so that you'll not be in panic, and then you'll not take hasty calls to just exit certain things. Okay, but the drawback is the more you diversify, the risk also gets reduced, but your return potential also reduces. Okay, so yeah, you cannot have it both ways. Otherwise, everybody would have done the same thing. So that's why there are, if you study or read some books, there are certain investors which are very high risk taking investors. So basically, if you see their risk on their overall portfolio, which will be very high. But there are certain investors who are risk averse, or they don't want extra returns at the cost of extra risk. For example, like Warren Buffett or something. So they are long-term investors, so they don't bother about short-term fluctuations, etc. And in that case, the risk will be very less for their portfolio as such. But I mean, this risk is relative to market. Okay, it's not like absolute risk. So it is always risk is always compared with the free market returns or something like that. Okay, so it's not like absolute risk. Anyway, so that is something called as risk aversion and risk acceptance. Okay. Depending on that, you have different these things. Like if you want to, let's say, diversify your portfolio, there is a theory called as Markowitz theory, which is nothing but broken egg shaped theory. So I had done one simulation. I'll tell you. For example, yeah. So let's say Before this class, I had done one simulation in which, one second. Yeah, this efficient frontier plots. Okay, so these kind of plots, we'll talk about them towards the end of the class. Let me just download them. Okay. And then you have, uh, yeah, this is what is called as efficient frontier. Okay, this comes in the regime of this thing, Markowitz theory. Okay, so there are many theories like this, but since it was discussed in the class, I thought I'll just do a simple simulation and then I'll tell you what kind of theory is this. Okay, so it basically tells you that uh, you know uh, if you have different assets in your portfolio, and how can you achieve the maximum risk, maximum returns compared to the, I mean, maximum relative returns without taking too much risk. Okay. So we'll see those. I had done one simulation. So I had taken three market classes and some correlations between them. And then, what you do, you do some simulations where you change their weights in your portfolio. Okay, so therefore I had done like 1,000 combinations of different weights that I can assign to this three sets of asset classes, and then based on that you get this frontier dome, etc., etc. Okay, so we'll come to that, but let's start with the discussion about this risk and all. So first, in the first class, we discussed some important terms like risk. Okay. So let's start with that. So this risk, basically, since this is a financial mathematics course, we are talking in terms of financial assets. Okay, so risk is there everywhere in all aspects of your life, but in certain cases, risk is defined particular to that subject. So in financial mathematics, risk is defined as probability of an undesirable financial outcome. Okay, so basically that means this means either loss or low returns. Okay, so it is not always that you will lose money, but let's say in another safer assets, if you had put the same amount of capital, you would have gotten certain X amount of returns without taking much risk. And if you get lesser returns than that in your riskier assets, then that's a risk, no? Because you are losing some money there. Okay, so that is called as low returns or negative returns. This is also called as negative returns also, or maybe leave it, because loss is also negative return, so that I think is understandable. So as I told you, you can assign certain probabilities in these cases. Okay, so these are certain events where you have some idea, or certain assets classes where you have some idea about the, you know this thing, what you say, uh, probability, so that you will get the historical return. For example, uh, you know then we define something called as expected rate of return. Okay, so this is on your portfolio. Okay, so it is nothing but weighted sum of possible returns and their probabilities. Here you can assign probabilities, therefore you take the help of those probabilities. For example, you can take one simple example. Okay. Let's say you know an investment as following possible returns. So you have a table, return in percentage, and what is the probability of getting those returns. Okay. So there is a 30% probability that you'll get 5% return. There is a 10% return and it has probability of 40%. And similarly, this will be 50% and this is 15%. So in such cases, you can define expected rate of return. Okay. That will be nothing but you have to take the weighted average. Okay. So in that case, it will be 5% into 30%. So let's say 0.3 plus 10 into 40% is 0.4 and 15 into. Okay. So this will be 1.5 plus 4 plus 7.5. Okay. So that comes out to be 13, right? Is it not? Oh, actually this cannot be 50% because the probability is I must add to 100, right? This will be 30 only. So therefore, instead of 0.5 here, it will be 0.3 and this will be 4.5 and then you will get 9, 10. So that will be your expected rate of return. Okay. So this is how you define expected rate of return in these kind of cases where you can assign certain probabilities to your events. Okay, so this you may wonder why do we get 5% return and 10% or 15%. So these markets or any type of markets, they are not static, they are dynamic. So when they are going in downturn, you may only get 5%. When they are in upturn or bull market, as it is called, you may get higher returns. So these probabilities are basically those probabilities. This 30% represents the probability of pessimistic markets. 30% represents probability of optimistic markets, and this represents the probability of neutral markets. So not much big returns you'll get. Okay, so like that. Then there is something called as dispersion. Okay. So there is a term called as dispersion. It is nothing but the name. Dispersion is nothing but the range of highest and lowest possible returns. So range of highest and lowest possible returns. Okay. One second. So yeah, here only you can see the dispersion, right? Dispersion will be, in this case, uh, in the same problem, it will be 15 minus 5, so 10%. So basically, it shows how much swing you should expect in your returns in the, you know, you know, uh, like optimistic as well as pessimistic case. But usually, we don't consider dispersion as the correct criteria or the, widely used criteria for measuring the volatility or risk associated with your asset class or investment. We usually use something called as standard deviation. Okay. So you might have heard this term in some other context because this is usually taught in +2 also. So the standard deviation basically measures the spread. It measures the spread of returns around the expected value. Okay, so that's why we first calculated this expected rate of return, right? So that is your expected value. Okay. Usually, standard deviation in any field of maths is nothing but around a mean. Okay, so in this case, the mean is expected value. Okay, so we can take the same problem. Our expected value was how much? 10%, right? So in that case, how do you calculate the standard deviation? Is nothing but, the standard deviation is actually the square root of variance. Okay, it is usually the square root of variance. Okay, and the variance is nothing but nothing but square root comes in standard deviation. Variance is essentially summation of all the possibilities. Okay, so you have to include all the probabilities into, so you have to sum it up over all of them, and then you have to uh, individual return minus the expected return, and then you have to square it up. So in this case, in our example, this is your R, okay, and expected return of rate of return is your E of R, okay? And these are your probabilities, individual probabilities. Okay. So then in first case, your probability is zero point 0.3 and return is 5%, and then the mean is 10%. We have to square it up. Then there was 0 0.4, 10 minus 10 whole square. Then there was 0.3, and then 15 minus 10 whole square. Okay. So this becomes 0 0.3 into 25. The second term goes to 0 because of 10 minus 10. And this is also 0.3 into 25. Okay. So that is 0.6 into 25, that is 15, right? Yeah. So this is your variance, and therefore your standard deviation is usually denoted by sigma, which is your standard deviation, is nothing but square root of 15. Okay. Okay, so square root of 15 is nothing but 3.87. Okay. So the standard deviation has significant meaning. Okay, it's not a random number. Basically, if you assume that the distribution, underlying distribution of your rate of returns is like a Gaussian distribution, in those cases, you will have like 60% or 68% of your data values within the plus minus 1 limit. That is called as 1 sigma. Then there is something called as 2 sigma, 3 sigma, like that. Okay, so these kind of limits are there, and that sigma is nothing but standard deviation. So based on your data, the standard deviation value is changed. Okay, and usually we consider the standard deviation as the measure of the volatility. Okay, it's a standard measure across many assets. Standard deviation is used. But you should remember one thing, that the standard deviation is based on the historical data, because this rate of return values that you are expecting with some idea on your based on your historical data. Okay. Then there is something called as coefficient of variation. nothing but CV. It's also a famous number, but the main objective of this number is used to compare uh, the spread of various distributions around their respective means. Okay, I mean the definition is you can define CV as sigma by uh, mu or mean. So there is E of R in this case. So that will come out to be 3.87 divided by 10. Okay, so the number will be 0.387. Okay, so if you want to express it in terms of percentages, that will be 38.7, or otherwise this is 0.387. Okay, so somewhere they can express this as 38.7 also. That is fine as long as you know what is the number. But what they do is usually they will calculate the coefficient of variation for first first data set. Let's say it is 10%, and let's say coefficient of variation for second data set is around 20%. In this case, you can guess that the data points in data set 2 are widely spread around its mean. Okay, so we don't know what is the mean and what is the standard deviation for both of these data sets, but if you know the coefficient of variations, you can guess that you will have more dispersion about the mean in second data set as compared to first data set. And then once you have that idea, you can proceed accordingly, because there are different techniques that you can apply to various types of data sets. And depending, if you have certain idea, it becomes easy to use those things. Okay. And then this was about your first class. Mostly these were important questions, and there was some discussion on this Gaussian. So for a Gaussian distribution, if you take the mean, which is we are calling it E of R in these previous examples, and if you take plus minus 1 sigma, that covers your 68.7% of all the possible data points. Okay, and if you increase this sigma, for example, if you take it is 68.26, it is 68.27, not 7, but I mean that number really doesn't matter, as you should have some basic idea. Okay, if you take 2 sigma deviation, that will be 95.45, and if you take 3 sigma about the mean, it covers almost all of the data points. Okay, so 99.73. There are certain minor data points where you won't have these things. What do you say? Like you'll not cover 100%, because these Gaussians have tails going up to infinity, right? So therefore there will be always something. But if you consider 3 sigma for all practical purposes, we consider that all of the data points are included. Okay. Then there was discussion on the uncertainty. See, this is about risk. So risk, as I told you, where you have probabilities, certain idea about probabilities, but there are certain events where you don't have any idea about the probability of those events. In such cases, that is called as decision making under uncertainty. Okay, so that was our discussion. Decision making under uncertainty. Okay, so the idea here is you will not have the idea about the probabilities. So here uh, you will not know unknown probabilities basically, and that is the difference between the first part of this class and this current part. So here you don't have any probability helps that you can use to calculate expected returns and all those things. So here are various criteria. Okay, so certain criteria that we use, and we'll take one example. But first of all, just you should know if you adapt one of the criteria and how it works. Okay, so if you take the first criteria, which is called as dominance criteria, in that case, you know, choose the option which is better in all scenarios. Okay, so whatever scenarios you have, we'll take one example, then you understand what do I mean by scenario. But you know, you should choose the option which is better in all of the scenarios. Okay? If such thing happens, then that's the dominance criteria, because that is the option which is dominating all other options in all the scenarios, right? But that's not the only thing, and that's not the thing that happens a lot of times in real life. Okay, so therefore there are other criteria such as aspiration level criteria. Okay, so in these cases, what you do if you are adopting this criterion, you have to choose the option or options that meet or that exceed the target return, okay, or desired return. So you should have certain idea about your uh, return that you expect from this investment, okay, or from this decision. And if some options are meeting that criteria, then you have to choose them. Otherwise, reject them. Okay. Then there is something called as most probable criterion. Okay. So here you have to choose the outcome or the option with highest one second. One second. Yeah, one second. Let me just check one thing. One doubt came to my mind. One second. Oh, uh, actually, we are under uh, risk only. Uncertainty. This is not uncertainty. Yeah, this is under risk only. Okay, that topic is not over. Uncertainty will have those things, Laplace and all those things. Okay, okay. Yeah, because this most probable uh, criteria tells you to select this thing, uh, option with highest probability. Okay, so that's what I was wondering whether, see, because when you say uncertainty, that means you'll not have probabilities, right? But yeah, still we are in the risk region only. The decision making criteria in uncertain cases, we'll see those also. there are certain Laplace and all those things, Hurwitz, all those things are there. Okay, yeah. So I think I overdid or ran in front of my own notes. Okay. Anyway, then there is something called as expected value criteria. Okay. So yeah, now it makes sense because I was thinking if we are talking about uncertainty, how can we have probabilities? Because we are still in the risk region only. Okay, anyway, so here, as the name suggests, you have to choose the option with highest expected or average value. So this part remains same. Okay. So instead of probability, you have to choose the value with highest expected or average return. Okay, and then there is last criteria, which is called as expected variance. Okay, so as the name suggests, in this criteria you need to consider or you need to choose the option which has highest expected variance. Okay, so basically this criteria it both considers both expected value and variability, which is given by the probabilities. Okay, and that is also called as risk. Okay, because in variance formula, if you remember, we have this, right, probability into r minus mean. Okay, so therefore it considers variability which is given by probabilities and expected values, which are difference between the current value and the average. Okay, so you know we can take one problem so that you understand what we do here. Okay. Okay, so this is an example, interesting one. So you have three investment options. A, B, and C. Okay, each has following potential returns. Based on market conditions. Okay, so you don't have only one scenario. For example, the data is given in this format. Let's say you have three options A, B, C, and the first set is so the first scenario is when you have optimistic case. So that means, let's say the markets are good, and then you need to consider those things in that context. Okay, so let's say this is your optimistic case, and this is your pessimistic case. Okay. So that means it's like a bear market, and then whatever you have conditions that are given. Okay, so they have given you return in percentage and corresponding probability in both cases. Okay. So same thing they have given you for in both cases you have those things. Okay, and the values are 10%, 8%, 12%, and the probabilities are uh, Yeah, so the probabilities are 0.6. So the probability of optimistic case is 60%, whereas the probability of pessimistic case for option A is 40%. And in pessimistic scenario, you can expect only 4% returns if you choose option A. Similarly, if you choose option B in optimistic case, you will get 8% return, and the probability for that is 70% or 0.7, and vice versa, it is 0.3 here. And here it is 0.5 and 0.5, and you'll get only 3% return in case of pessimistic scenario. Okay, so now we have to decide. Okay, so first, let's say decision by adopting. Okay, so the first thing is, let's say you adopted dominance criteria. So in those cases, what you need to see is, is there any option out of ABC which dominates in both the scenarios? And dominance should be, dominance should be in terms of percentage returns and in terms of probability also. Okay, you can't say only one thing, because dominance says across all the scenarios, all the cases, you should have a dominant this thing. Okay, or maybe you can just take percentage returns only, because if you take probability, that is actually a variance. Okay, so in case of just probabilities, percentage returns you take. So if you look at the data in if you compare option A and option B, so A performs better in optimistic case. I mean, what I'm trying to tell you is, let's say optimistic case, optimistic scenario. In that case, C is greater than A is greater than B, because 12% is greater than 10% is greater than 8%, right? So if you use this criteria, C should be the better option, right? But you should look at the pessimistic criteria, right? Because dominance is across all the scenarios, not only optimistic but also pessimistic. So in that case, if you compare, your option B is lucrative, then option A, and then option C, because 6% is greater than 4% is greater than 3%. Okay, so in this case, you would have said option B is good. Okay, so you are not getting single option in both the scenarios. Okay, so therefore no option dominates both scenarios. Okay, and therefore you cannot use this dominance criteria to make a decision. Okay, so dominance criteria or criterion cannot be used for decision. Okay, and in most of the practical cases, this thing happens, because dominance criteria is a ideal case, because if such criterion existed, everybody would have chosen that one only, right? But it doesn't. And therefore, you need these other criteria. Let's say you are deciding based on your aspiration level criteria. Aspiration level of, let's say, greater than or equal to 9%. Okay, so you want the criteria, like your aspiration is to have at least 9% return in any 9% in optimistic, and let's say greater than or equal to 3% in pessimistic, because you cannot have like 90% expectation in all the scenarios, right? Because it won't work like that. Okay, so then you have to compare the rate of returns. Okay, so what like in some cases you can only have optimistic aspirations, In some cases, you can only have pessimistic aspirations, but here I am taking both. Okay, so that's my choice, right? Because I am doing the investment. So let's consider optimistic again. So if you want greater than 9%, the options that meet the criteria are C and A, because C is 12% and A is 10%. And I want 3% in pessimistic C, or let's say 4%. That will give you one single answer correct option. Okay, so let's say I want at least 4% in your extreme case scenario or pessimistic scenario. So in pessimistic case, above than 4% are A and B. Okay, so this condition is satisfied by A and B, right? So therefore, choose option A. Okay? Because it satisfies both your aspirations in your pessimistic case also and in your optimistic case also. Okay, so this is how you use aspiration level or aspiration criterion. Then third was most probable. Okay. So most probable means it should have this thing, highest probability. Okay, highest probability. Okay, so if you look at the probability columns, in optimistic case, since B has the highest probability of 0.7, so therefore in optimistic case or optimistic scenario, you should choose B option because it has 0.7% or 0.7, which is 70% of the probability. Whereas in case of pessimistic, this criterion will tell you that option C should be selected because it has highest probability. But you can't select both. So for both scenarios, for like if you consider optimistic as well as pessimistic and you want to use most probable, in that case you will not have no suitable option, right? Because either you can select B or you can select C. You cannot select one of that, right? Because otherwise that is not a criteria in your optimistic or pessimistic case. Okay, so oh, it is 0.5, not 0.3. Okay, so like that. And then there is fourth criteria which says expected value. Okay, so the fourth criterion was expected value and then expected variance. So I'll not do all the calculations, but you can do on your own because the idea is same only. So in this case, what you need to do is you need to calculate the expected value of A in both optimistic and pessimistic. So in optimistic case, it is how much? 0.6 into 10, and in pessimistic it is 0.4 into 4. Okay, so it is 10 into 0.6 plus 4 into 0.4. That comes out to be 6 plus 1.6, 7.6%. Similarly, you need to find expected value of B and expected value of C. Okay. So B will be 0.7 into 8 plus 0.3 into 6. So I'm skipping those calculations. You can do those. 7.4 and you get 7.5 here, okay, if I'm not wrong. Okay, because C has 6 plus 1.5, so yeah, 7.5. Okay, so now in that case you have to select option A. Okay, so according to your expected value criteria, this is the suitable option. Okay, so then you have to go with the option A and do the investments. And then you have expected variance. Okay. Last criterion. And here, as the name suggests, you need to calculate the variance, okay, for each option. Okay, for example, sigma square in option A, that is given. Sigma square is nothing but the variance. So what will be the variance here? The probability multiplied by the individual entry and how much it is away from its mean. Okay, so this one plus square, and then in the pessimistic scenario you have 0.4 and the return is around 4 minus 7.6, which is the mean, and you have to square it and multiply. Okay, so if you do that, you'll get 8.64% return or the variance here. And similarly, if you calculate, actually it should not be percentage, just compare the numbers, okay? Because I mean it should be percentage square, right? If you're strict about it, so don't do that. So sigma square b will be, if you calculate, mean is 7.4 and individual returns are 8 and 6 for 0.7 and 0.3 cases. So I'm skipping those steps. You can do that, but you should get 0.84. Okay? And similarly, if you calculate the variance for this guy, the C option, it comes out to be 20.25. Okay. So expected variance criterion tells you to select the options with the least experience. Okay. Yeah, it should not be highest. Okay. In this case, it should be least variance. Okay, because variance this basically captures the volatility or risk associated with that option. So in this case, this will be a suitable option because it has least variance. Least variance. Okay, so this is how you use these criterions to make the decision when you know some probabilities. Okay, and like that you can solve some other problems also. And then let's come to the case where you have uncertainties, you don't have probabilities. Okay, so that is called as decision making under uncertainty, right? So as I told you, here you will not have the luxury of choosing the probabilities because the data is not there, insufficient data, or the events are very rare, or you don't have any idea about the impact of that event in certain cases, in all those cases. Okay, so you don't have uh, no known probabilities. That is the main catch here. Okay. So in such cases, what they do, okay. So in this case, there are like 4 or 5 criterions. So we'll discuss those only directly. Okay. So first you have Laplace criterion, and then you have Maximin, Maximax. Okay. So Laplace, what they do is they assume various criterions are there. Okay. So first is Laplace criterion, where they assume equal probabilities. Equal. So you assume here, okay, because you don't know, so you assume equal probabilities to all possible outcomes. Okay. And then you have something called as Maximin. Okay, Maximin criteria. Okay. So in that case, the mathematical formulae were given in the class, so I'm not writing them. You should know what is the mathematical representation. That's not the point, because we'll take one example and with that you can understand. So Maximin says it is a pessimistic scenario. Okay, so the worst case possible. And what is the worst case possible? That is, you choose In these cases, what you need to do is, maybe we can remove this. Okay. So in these cases, you basically choose uh, worst case out, best of worst case outcomes. One second. Yeah, so actually something came up. So there is this Maximin criteria. So here what you need to do is, uh, in Maximin criteria, you have to choose best of the worst. Okay, so that is why this Maximin name is. Maxim means best, min means worst. So you have to choose best of the worst case scenario. Okay, and third case is Maximax, if I'm not wrong. Yeah, so Maximax means this is like the optimistic scenario. Okay, so this is called as choose best of best case outcomes. Okay, so there could be 2 3 best case scenarios depending on the options that you have. So you need to choose whichever option is best amongst all of them. Okay, that is third criteria. We'll see some problems. Okay, so that will make it more clear. Okay. So then there is fourth option, which is called as Hurwicks criteria. So Hurwicks criteria is nothing but somewhere in between. Okay, so this is Maximin criterion. Everywhere you have to write criterion. Hurwicks criteria basically is somewhere between option 2 and 3. So what they do is they basically use something called as index. Okay, Hurwicks index or relative optimism and pessimism index. Okay, so they use something called as alpha, which will have value between 0 to 1. Okay, and this is called as index. Okay, so this is some index. Basically, it's a number that you assign. So it is called as index of relative optimism and pessimism. Okay, so 0 represents like full pessimism and 1 represents full optimism. Okay, so 0 represents your case 2 and 1 represents case 3. Okay, so this is called as Hurwicks criteria. And then there is fifth one, which is called as regret, minimax regret. Okay, so here you need to find something called as regret first, and then use minimax criteria on that. Okay, so minimax means you have to find the worst. Sorry, max means you have to find the largest regret and take the smallest value out of all the possible criterions. Okay. Okay. So here you need to choose uh, choose worst worst or lowest out of maximum possible regret options. Okay, or regrets. Okay, so we'll see some examples and then you'll understand what we are talking about. Okay, so let's take one example so that you'll understand. Okay, so there is a question. You know, you have to decide between uh, you have to decide between 3 products to launch. Okay, and these products are A, B, and C. Okay, and since these are new products, since uh, these are new products, there could be strong. Let's say we use S, capital S for strong, moderate. Let's say capital M, and weak. Let's say W. Responses for these launches. Okay, and you don't know the probabilities because these are new products, right? How can you assign probabilities like that? Okay, so then you have some idea about the payoff table. or payoff chart in lakhs. Okay, so what you do is you expect that, let's say you launched, product A, B, and C, and if it receives a strong response from the public, then you get, let's say, 80 lakhs as the revenue or profit, whatever you want to call, and respectively 70 and 100 for these products. Okay, this is your first case scenario. Let's say they receive moderate response, then what happens? You get 50, 60, and 30. And let's say they receive weak response, let's say W, then you only get this many payoff table values. Okay, and now you have to decide which product should you launch. Okay, so let's say you use first of all Laplace criterion. Okay. So Laplace criterion, as I told you, it assumes equal probabilities for all the possible scenarios. So that means for product A, expected values that you can calculate, because now you know the probabilities, right? Because you assume equal probabilities, so you can calculate expected values. For A, it comes out to be 80 into 1 by 3 plus 50 into 1 by 3 plus 20 into 1 by 3, because you assign 1 by 3 probability to all the possible values. Okay, so basically that is nothing but 50. And similarly, you do the same calculation for B option. You should get 170 by 3. So that means 56.67. And for option C, you will get 130 by 3. That is 43.33. Okay. So out of these options, since this has the highest expected value, according to Laplace criterion, you should launch product B. Okay. But let's say instead of Laplace criterion, you wanted to use Maximin criterion. Okay, Maximin. So this is nothing but the pessimistic scenario. So you have to choose maximum value out of the worst possible cases. Okay. So how do you do that? So what is the minimum for option A? Minimum payoff that is possible in option A. If you look at the values, that is 20, right? Where you receive weak response. Similarly, what is the minimum value out of all responses for option B? That is 40. What is, that is what you receive when you get very weak response for this launch. And this is the for C it is 0. So out of these all the values, you have to choose the best value or maximum out of this. Maximum value out of this is 40, right? So therefore, in this scenario, option B is the suitable option. Okay. Because this is Maximin criteria. Okay. Similarly, you can choose the third option, which is nothing but Maximax. So this is like you expect all of them to have very strong response or very strong demand after the launch. So in that case, you need to consider max of all. So that will be nothing but the strong response column, right? So max of A will be 80, 70 and 100, right? 70 and 100. And then you have to choose the maximum out of this. So maximum out of this is 100. So therefore, option C is the correct decision for launch if you consider Maximax criterion. Okay. So option C. Okay. And then you have this Hurwitz criterion. So here now the question is, what should be the value of alpha, because this criterion needs alpha so that you will have some idea about the pessimism and optimism in the market conditions. So let's say you take the alpha value of 0.6. You can take any other value. Usually it will be given in your question, but if not, let's take some value. So in this case, this something called as Hurwick's payoff in this case, because we are dealing about the payoff values, will be nothing but alpha into. So this will be for one option. Okay, alpha into max plus 1 minus alpha into min. Okay. So for option A, what will it be? 0.6 into 80 plus 0.4 into minimum was 20. Okay, so this comes out to be 48 plus 8, that is 56. Okay. Similarly, you have to choose, calculate for all these values. You will get 58 here, and for option C, if you do the same calculations, you will get 60. Okay, so these are called as Hurwick's payoff. Okay, and then you have to choose the highest value out of this. Okay, so max out of this is 60, right? So therefore, according to Hurwick's criteria for this value of alpha, this is the suitable option, because you have to choose the highest value of these payoffs. But as I told you, if you take alpha as 0.6, you'll get these numbers. But if you change the value of alpha, you'll get different things. Okay, so that is how it goes. Then the fifth criteria, which is the minimax regret. So here the key concept is to calculate the regret. Okay, and how do you calculate the regret? Regret is nothing but regret for an option is nothing but you have to consider the maximum value in the given column and subtract the respective values. Okay, so maximum value in a column and subtract individual entries. Okay, so this is not for one option. This is for regret for all options, you can say. Okay, and it is given like this. Okay, for example, you had options A, B, C, right? So what is the maximum value in this column? First column of strong, it is 100. So you have to subtract this thing 100 from all the column entries. Okay, so in that case, what happens? This was for strong demand. So this 100 minus 100 is 0. Then 100 minus 70 is 30. And here you'll get 20. And if you do the same for these all these things, you'll get 10, 0, 30. Okay, because in moderate option, the 60 is the largest, so you have 10, 0, 30. And here 40 is the largest, so you'll have 20, 0, 40. Okay, so here you'll have 20, 0, 40 for weak demand case scenario. Okay, so now you have to find the maximum regret for each of the option. So in this case, maximum regret for A, or we can write it this way, maximum regret for option A comes out to be 20, right? Because it is 20, 10, 20. So maximum value is 20. For option B, the maximum regret is 30. And option C, the maximum regret is 40. Okay. And then you have to use the minimum of this. Okay, because this is a minimax. So max we already considered. So out of this, minimum value is 20, right? So that means in that case, option A is the suitable option. So that means based on minimax criteria, your option B, option A minimizes the maximum regret. See, this regret is kind of, if you, whatever you are predicting in these values, if that doesn't go wrong, you will have some regrets because you will lose or something, right? So therefore, you need to minimize the overall value of maximum regrets possible. So that is how this minimax criteria works. Okay. And then there was some discussion about risk and all those things. Okay. But as I told you, I have done some simulations for this. Okay. Because in this discussion about portfolio return, etc. First of all, in any portfolio, there are two things. One is the weightage for individual assets, and then uh, you know what are the movements in that asset. So that's how you calculate portfolio returns, right? And risk premium is nothing but something which is risk on return on your asset minus return on risk-free asset. So usually government uh, securities, we consider them as risk-free because the probability of default for a sovereign bond or something is considered as zero for all practical purposes. And then I hope all of you know how to calculate the portfolio returns, because this is a very common topic nowadays. So whatever, like however many stocks you have, they will be multiplied by the rate. I mean, their change will be multiplied by the respective uh, weight in the portfolio, and that is how the overall change in the portfolio is calculated. Okay, I mean that is quite well known nowadays, right? Okay. Okay, maybe just for the sake of argument, let's say your portfolio. Okay, so this decision under uncertainty is over. Now we are talking about this diversification of portfolio, etc., etc. Okay, so so first of all, you should know how to calculate the expected return of a portfolio. So let's say you have portfolio. Following portfolio is there: stock and weightage. Okay. So and how much amount is invested? Initial amount invested. Okay. So for example, let's say you had three stocks ABC, and they had weightage of 30%, 40%, 30%, and you have invested about 3,000, 4,000. Oh, and 3,000. Actually, the probabilities are these expected returns, or you can call weightage also. So in that case, uh, instead of weightage, we should say how much it moved. Okay, so that you'll understand uh, how your portfolio moves. Okay, so move from initial point. So initially it was at 30%, and then it moved by initially you invested 3,000, and then the stock moved by 30%. So the final amount that you'll have is this 3,000 will become 1.3, so it will become 3,900. This will become 1.4 into 4, so that will be 5,600, and this will be again 1.3 into 3, so that will be 3,900. Okay, so your initial value of your portfolio was around 10k, and now it is about so 10 1 3. Okay, so you have like 13,400. So even though your stocks moved with certain individual percentages, uh, the overall movement in your portfolio is about 3400 on the initial amount of 10,000. So that will give you about 34% of overall returns. So this is how it goes, because there is one classic problem that is usually quoted in all of these things is, let's say you have 10 stocks in your portfolio, equal weightage 10% for each, and let's say one of them becomes double in the absolute terms. So let's say one stock A become from X it goes to 2X, but in your portfolio it will only contribute to from 10% to 20%, and therefore your overall portfolio is increased only by 10%. Okay, because 1.1 by 1, that is 10%. Okay, so that is why it is a choice, because if you want more returns, you need to have less number of stocks, but that is it comes with the more risk also. Okay, because if it goes up, then it's well and good, but what if, let's say, you have only 5 stocks in your portfolio? If all of them become double, your portfolio becomes double, but all of them, if they become half, your portfolio will also be half only. Okay, so that is the problem. That is the dilemma between diversified portfolio and the concentrated portfolio. Okay, so if you have smaller capital, it is usually said that to grow it faster, you need to have a concentrated portfolio. But once you become quite large, then you should have a diversified portfolio, so that you are protected. Your initial investment, which is itself large, will be protected. Okay, so like that. And then there was talk about, see, if you have more number of negatively correlated assets in your portfolio, that will reduce the portfolio risk, reduces your portfolio risk, because as I told you, if one goes up, another goes down, so that is the advantage in those cases. Okay, but then you will ask me, what are the negatively correlated assets? There are a few. For example, I was reading about it. For example, these stocks and real estate. See, basically there are, I mean, nowadays there are cryptocurrencies also, but their correlation is not that well established. But see, yeah, and this correlation is basically, there is one correlation coefficient which is calculated as covariance of two assets X and Y divided by their standard deviations. Okay, and how do you find covariance of X and Y? Is the thing, but you need to take the expectation of xy minus expectation of x, expectation of y, and the denominator remains the same. Okay, so this is called as coefficient of correlation. Okay, and it will always have value between -1 to +1. If between 2 x and y, if the value is -1, that means they are perfectly negatively correlated. That means if x goes up by 1, y will go down by 1 unit. Okay, and if they have the coefficient of correlation as 1, that means they are perfectly positively correlated. Okay, so that means if x goes up by 1 unit, y will also go up by exactly 1 unit. Okay, and then all of the rest of the cases are in between. So if r is equal to 0, that means they are independent. Okay, so x and y are independent. So that means whether x goes up or down doesn't matter. That does not have any significance for change in y. But as practical case is concerned, there is something called as correlation matrix. So these values are some random values, but within some practical range only. Okay, so what I'm trying to say is, let's say you have a correlation matrix. Let's say you have stocks, and let's say B is nothing but government bonds or in general bonds, C is, let's say, gold, and let's say D is real estate. Okay, so these are quite widely used assets in typical portfolios. Nowadays, cryptocurrencies are there, but not that much in India, and also globally, their correlation is not that well established so far. Okay, so this matrix will have all the diagonal entries as one, because basically you are correlating same this thing, same asset class with itself. So all the diagonal elements will be one. But the off diagonal elements, it will be a symmetric matrix, because covariance has a property that if you take covariance of x and y, that is equal to taking covariance of y and x. Okay, so therefore this correlation matrix is always symmetric matrix. So whatever entries you have, it will be having same entries here and there. Okay, so here also it will be 0.1, 0.1, 0, 0, minus 0.1, minus 0.1. Okay, so something like it will be this. So usually, usually it is said that A and D. A is your stocks and D is your real estate, as well as B and C. B is your bonds and C is your gold. Okay. Usually they are positively correlated. Okay. So that means if one of them goes up, other will also go up, and vice versa. Okay. Whereas if you see between B and D, so your B is bonds and D is real estate. Their, their coefficient of correlation is more or less 0, usually speaking. So therefore, they are independent asset classes, usually speaking. If you purchase any bonds which are of a real estate company, then it's a different thing, but in general speaking. And similarly, if you consider A and C, A is your stocks and C is your gold. Okay. So in such cases, you can see their correlation coefficients are A and C, right? That is minus 0.4, no? This entry. So that means they are negatively correlated. Okay. And similarly, if you consider A and B, which is stocks and bonds, so they are also negatively correlated. Okay. So that is why it is said that if you have like equity portfolio, it is good to have certain percentages of your portfolios in gold as well as bonds, because they are negatively correlated, and that will reduce your overall portfolio risk. Okay, so that is the main idea about these things. Okay, and then you can calculate all uh, these things. What you say? Let's say you want to calculate the portfolio risk. Okay, so this is a correlation matrix. Then you'll have certain weights also, right? Let's say in your portfolio, this is having weightage of W1, W2, W3, and W4. Okay, so that means these are weights or percentages in your portfolio. So in that case, W1 plus W2 plus W3 plus W4 will always be equal to 1, right? Because these are nothing but fractions of your portfolios. Okay. And let's say this coefficient matrix is denoted by sigma ij, because these are nothing but covariances. Okay. So then your overall portfolio risk is defined as sigma p square. So basically we talk in terms of variances here, and that comes out to be equal to wi square and uh, sigma I square. Okay, because these are nothing but your diagonal entries. So whatever weightage you have for, let's say, stocks and bonds and gold and real estate, you have to just multiply that and multiply that with its coefficient, that is 1 only, and then you have to because the sigma ii, these are individual variances, right? Yeah, 1 second, there is a catch here. Let's not call this as sigma ij because these are correlation matrices, right? So let's call them as, let's say, beta ij, because then it will be more correct. Yeah, so instead of sigma ii, it should be sigma I only, and then you have another cross multiplication term where your I is not equal to j, so that means these are off diagonal entries. So in that case, you have to multiply I and j weightage with the individual standard deviations, and then you have to multiply by beta ij. Okay, so that comes from this matrix, correlation matrix. Okay, so this is the part which is nothing but, it captures individual variances in your portfolio, and this part captures pairwise covariances between your assets. Okay. So that is why it is said that, when you have negatively correlated assets, this second term will be going down if you have negatively correlated assets, and therefore your overall portfolio risk goes down in that case. Okay. I'm not going to do these calculations because it will take some time. Instead, what I'll tell you, I'll show you one interesting thing. Okay, because I took one problem and I solved it using this thing, coding. Okay, so let me just give you that question so that you understand the importance of all these things. So I constructed a portfolio of having, let's say, 3 asset classes. See, I mean, you should be able to find the correlations, etc., between these two pairs, etc., because these formulas are there. See, this is expectation of xy, right? So you have to calculate xy and then take sum of it and then divide by total number. Okay, so like that you have to do. So those things I'm leaving to you, but since we are at the end of the time, I'll just give you one simple problem that I created myself. Yeah. For example, so let's say you have uh, 3 asset portfolio. Okay. Let's say you have assets A, B, and C, and expected returns are 10%, 8%, 6%. Standard deviation, which is also called as risk also in some cases, it is given as 15%, 10%, and 5%. Okay. And then you have certain this what do you say? This is about the expected returns and standard deviation matrix. Then you have correlation matrix. Okay. So here, as I told you, it will be a symmetric matrix with all the diagonal elements as 1. Okay, so 1, 1, 1, and A and B are positively correlated, whereas A and C are negatively correlated. And similarly, B and C are they are not correlated. So okay, they are independent assets as far as variation is considered. Okay, and then the question is to find optimum weights for assets A, B, and C, so that you will have optimum return. To have optimum return. And I'll tell you what do I mean by optimum return. Optimum return means uh, risk at maximum risk adjusted return. Maximum risk adjusted return. Okay, so that means how much extra you achieve above the market free risk return divided by the risk that you take. Okay, so this is like incremental return. We have seen this in the last class also. So that's why I use one criteria. Okay, so solution is take or random weights for 1000 trials. Okay, because I know the values will be between 0 to 1, right? So I took like random 1000 values for weights and plotted these things. What do you say? Yeah, when you plot portfolio risk versus portfolio return. Okay, so return versus risk, return versus risk. Okay, so if you do that, what do you get is you get an interesting curve. Let me just show you. Okay. One second. Let me just check. One second. One second. Yeah, one second. I have that image, but why is it not coming here is the question. Uh, can I copy? Can I just paste it over here? Yeah. Okay, so this is what I did using some simple Python coding. So here you'll see for each and every weight, this dot represents each and every weight. Okay, and then you get a curve like this. Okay, and this is what we call as a efficient frontier curve. Okay. So this curve that you get is called as efficient frontier. Efficient frontier. So this curve. So this tells you that this is called as efficient frontier. Okay, and this in your class also, if you see the notes, there was this term which is defined as uh, broken egg curve, right? Something shaped broken egg shaped area. Okay, so this is the same thing, but the broken egg shaped curve, something like that, area, whatever. Okay, so what it tells is if you take, let's say, if you consider this point, let's say you consider this point somewhere. Okay, this point. That means you cannot achieve more than 9.5% of portfolio return if you take only 12% of risk. Okay, if you want to achieve 10% of return, you have to take higher risk like 0.14 or something. Okay, so this is what this efficient frontier is called as. Okay, and then what is the optimum scenario is the question, right? Because you know, I may have various options, right? But I want to find, you know, which will give me optimum solution, right? So optimum solutions portfolio means if you take, in this trial, whatever the weights were there, for that you will get return of 7% approximately, with only 4% risk. Okay, so this is the best case scenario. Okay, so this is the point which tells you